Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorgen. I'm here with London Paul, as always. And Paul, last Friday, we had the first bank failure here in the U.S. since April. That, of course, has led to other things that are showing cracks in the markets, in the financial system, in the banking system. Primarily, all of this is starting to occur after the Fed cut rates to only see the yields on treasuries start to spike up, showing that inflation hasn't been taken care of. Anyway, Paul, I want to thank you as always for being a part of this discussion. And definitely the treasury market and interest rates are the best place to start.
Yeah, well, obviously, thank you as well for joining me today, Ken. Pleasure as always. Yeah, it's an interesting talking point. What I'd like to say, and probably this is the first time I've said it in this format, or maybe it isn't, but anyway, the whole point of raising interest rates for the United States had nothing to do with curbing inflation. It was all to do with trying to keep this notional idea of strength in the dollar. It was designed to try and weaken emerging market currencies and force them to go with a begging bowl to the IMF, the World Bank, for more dollars. And of course, that has failed spectacularly. And there was always going to come a point for the United States where the reality would mean they had no choice but to start to lower interest rates, because the truth of the matter is, the fact the US raised interest rates to over 5% should have long since blown up the interest rate swaps market. The fact it didn't tells you there's something very, very strange going on, and there must have been something put in place to prevent banks collapsing because of that. Also, of course, raising interest rates after a long period of zero interest rate policy should have really seen a lot more problems in not just inside the financial system, but in the real economy, because everything in the United States, rather like the Western nations, is predicated on endless credit. Well, if credit gets a lot more expensive, you're going to end up having problems. So I think fundamentally the Fed had got to the point where it doesn't matter what data they produce, economic and financial reality dictated that they had to start cutting interest rates. Bear in mind, this has nothing to do with inflation. Also, of course, in the process, that would have therefore been a signal of the dollar weakening, which hasn't happened. And it should have also, as Ken, you rightly said, should have seen US Treasuries, the yields falling. And in fact, the reverse has happened and yields are continuing to spike. It's a particular problem maybe at the sort of mid and long end of the yield curve. And as you said, Ken, this is symptomatic of the fact that inflation is still perceived to be a problem. There is also the question in all this is that are the Chinese, for example, dumping enormous amounts of treasuries or other entities, and they're going to try and hide the fact that those treasuries are being dumped, so someone will have to buy them. And you know, for me, the Treasury report is meaningless, because the idea there's all these foreign buyers who just happen to be in the Cayman Islands, as one example, is not indicative of any foreign buying. So we're back to that point again, where no foreigners have effectively been buying US Treasuries for a decade. This is why gold is increasingly being seen as a reserve asset as opposed to US Treasuries, and that's increasingly something we're seeing in the global South nation. So I think for me, that's a good introductory point with regards to a bit of historical context and where we are today.
Yeah, definitely. And, it's kind of interesting because what first led the Fed to, well, obviously, when you're at zero ZIRP interest rates, every yield on the Treasury is above the Fed funds rate. But they brought it up to 5.375, 5.5, something like that, 5.35 to 5.5. Now all of a sudden they've taken down 50 basis points, so it's sitting at 4.75 to 5. But the Treasury yield for the 10-year today just crossed back over 4.3%. We're getting very close, and any type of stimulus to this could cause the actual Treasury yield for the 10-year or the 30-year, either one, to suddenly go above the Fed funds rate. And this is exactly the problem that they experienced back following the opening of the economy after the pandemic. So the Treasury market is very quickly getting out of the hands of the Fed, if the Fed even had control of it over the past four to 5 years anyway. The Treasury Department is sitting, with an individual running it who was more than happy to pretty much print to infinity. She's an MMT student. So take a look at what the U.S. government has borrowed in deficit spending over the past month and a half, 3 months, year, 18 months. We're talking a jump from 31 trillion to 35 trillion in less than 2 years, probably in the last 18 months. So the fiscal policies of the U.S. are completely, they're not even bothering to worry about the fiscal policies. The Fed is out of control of the treasuries, and the treasury markets and the treasury yields are far more important than the stock markets, than any other asset class out there. As I mentioned, we had a bank failure. Well, there was a report from the FDIC that there's upwards of 500 U.S. banks that are underwater in their, what was it? Yeah, they're underwater in their valuations in regards to commercial real estate. And that's something I think we're going to talk about here in just a moment. The commercial real estate fall is, there was a big hit. It led to SVB and a few other banks, mid-level banks, failing. But that hasn't stopped. And what that does too is that the decline in commercial real estate means a decline in the property taxes as well as the taxation for cities like San Francisco, Chicago, et cetera. And we're seeing companies move out of those big areas, California, Illinois, New York, et cetera, to lesser tax states, which means that the revenue of these over-bloated bureaucracies is going to get even worse along the lines. And when that happens, you're going to start seeing more people leave, more businesses leave, the commercial real estate problem for these skyscrapers expand even more. And it's just going to be a domino effect when it comes to the entire financial system, because somebody, if you go out on X or Twitter, whatever you want to call it, and there's always somebody saying, why is my car insurance, why is my home insurance so high? Well, the majority of these insurance companies had their investments not necessarily in treasuries, but in commercial real estate. And the massive decline in value of the commercial real estate is forcing them to have to up the premiums, because also the EV mandates, these cars now are $70,000, $80,000 rather than $40,000. And one of the big things is there's just not enough mechanics who are able to fix these cars. They're having to just completely scrap them rather than repair them. And that is a full cost thing. So there's so many different things that are tied intrinsically to, financialization has done that. And when one domino breaks, it just cascades through the entire system.
Yeah, absolutely. And just some of the points to add to this. There was data out today for the US trade deficit, which was forecast to be minus 95.9 billion, came in at minus 108.23. Well, again, this proves that not only have you got these enormous fiscal deficits, you also got enormous trade deficit. And they seem to be continuing to grow and grow larger and larger. And there's no sign that that is going to that gap is going to narrow. And that's an enormous problem for the US as well, another indication of just how weak the US economy is. But it's worth then, obviously, as you say, Ken, moving on to, well, no, before we move on to the issue of all the unrealized losses that exist in the financial sector and in US banks, it's worth noting that when the Fed decided to lower interest rates, there was an expectation amongst the commercial banks, etc. Well, now's the time to buy US Treasuries quickly because they're going to keep lowering interest rates. And, they were expecting yields to fall on US Treasuries. Of course, the exact opposite happened. So all these banks who bought mortgage-backed securities, non-mortgage-backed securities, to the tune of, well, and it's difficult to know, but hundreds of billions of dollars, are now starting to get very nervous about, well, what's going to happen next? Are they going to continue to lower interest rates? What's is this going to address the problem? Or because basically the US Treasury market's broken in totality. So that's an enormous problem they weren't expecting to have come to fruition, and it has very rapidly. Therefore, that starts to play into this issue of unrealized losses that exist in the banking sector. And, and these are enormous as well. And that's worth just talking about the fact that there are reports that, US banks are exposed to real estate debt and have maybe 750 billion in unrealized losses on real estate securities as of the end of Q3 of 2024. We're not saying all those losses are going to be realized, but the claim is, of course, and it's correct, this isn't limited to real estate securities. Banks are also seeing big losses in treasuries and corporate bonds. And, we're not going to get into mentioning specific banks, but there's banks with huge problems. Like some of the bigger banks may be as much as 100 billion potential losses. And therefore, the question is, when does this become a serious problem? Because there's also claims 47 banks have losses exceeding 50% of capital equity. And it's not just necessarily, of course, the medium-sized banks like we saw previously who are at risk. This could start to engulf the larger banks. And this problem could continue to grow and escalate and become more and more of a serious problem. And it's one of those things that unrealized losses don't seem to be a problem until they are. But it shows basically how overexposed banks are if rates don't move in their favor, and if for some reason the yields continue to rise. Then potentially, the US is going to continue to issue more and more debt. Which who's going to buy it? It's the first question. If no one buys, they just print. Well, that has implications in terms of the interest that has to be paid on the debt as well in the future. So this has huge, broader ramifications. Not, very simply the fact, well, these big banks can absorb these losses. It doesn't matter if they're tens or hundreds of billions underwater. But if the small percentage of American banks have liabilities and losses over 50% of their equity capital, what happens if that starts to continue to rise? It's only a small percentage, but it gets bigger and bigger. And then what's the contagion risk of how that spreads through the banking system? So these are enormous problems. And this is what happens when basically, when you think about it, when the Fed started raising interest rates, the equity market should have taken a hammering, and they didn't. The equity markets continued to rise to all-time highs. There was just this complete dislocation between the reality of raising interest rates and what the ramifications should have been. And now we're finding when they lower interest rates, the same kind of peculiar issues are starting to rear their head. And we saw, of course, the issue of gold price rising when interest rates were hiked. And really, as we said previously, instead of gold being 27.50 or 27.70, we're at a new all-time high recently, then the question is, it should have been at 1200. Why wasn't it 1200? We're not here to discuss gold and silver, but you can see all these discrepancies in how markets should behave. But this is what happens when you spend over a decade manipulating markets and try, because of the financialization of economies, and now, you know, the proverbial chickens are coming home to roost.
Yeah, there's a lot of reasons perhaps behind it. I mean, most of the stimulus that was done during the pandemic went to the big banks and the hedge funds. You take a look at what happened with the, you know, all all the stock buybacks and all the $1.3 billion chip act that was done. Most of that money went into Nvidia and other things. And if you take a look at equities, obviously most of the equity markets have reached 42 new all-time highs this year. And how's there $6 trillion in money markets? Where'd that come from? That came from the accumulation of the past 12, 15 years of QE to infinity and ZERP. You know, currency or money or whatever doesn't disappear. It's like energy, you know, if it transfers from one thing to another. So it hasn't been gobbled up by the Fed and just removed like in previous during recessions where the toxic debt eventually gets dissolved or bankrupt or whatever. Financialization and the Fed working hard never to have a recession just keeps accumulating all of this massive money, money supply. And that one, well, guess what? That's automatically going to bring inflation to the masses. And it's, this inflation to asset prices. But the whole thing is built on shifting sand. Because you mentioned the $750 billion estimated underwater losses right now in regards to commercial real estate. You sent me a chart of unrealized gains and losses on investment securities, i.e. treasuries, derivatives, mortgage-backed securities, things like that. Going back to coming out of the pandemic, really early 2022, nearly everything on Wall Street has been underwater, the unrealized gains. It got as bad as $675 billion early this year, but now is still sitting at minus $525 billion. Why? Then the question is, why is the equity markets, why is something like Bitcoin, sorry there, Luke Air Force Base flying over. Why is the equity markets, why is Bitcoin, why are housing prices up? We had yesterday, the mortgage rate for 30-year loan just hit 7% again. Why are these things so much higher? Well, take a look at what's going on in Europe. They're cutting rates. The dollar has suddenly reversed from being nearly falling below 100 on the DXY to getting up to 104. Why? Because the ECB cut rates, the Bank of England cut rates, the Bank of Canada, they're all cutting rates at a faster clip than the US is. So the dollar isn't necessarily stronger. It's just the least ugly shirt in the Western currency basket. So, what we see on the surface is not indicative of what's really going on underneath. It's really like an iceberg. We just see one little portion of it, but the rest of it's toxic and underwater.
Yeah, and the other problem is you've got certainly banks are warning increasingly of rising bad loan provisions. The loans that are souring eventually, they're going to have to write them off probably. That's only going to increase. Then there's all the problems in private equity, which has exploded as a market and is now completely out of control. It's not regulated properly. Where we have problems with collateralized loan obligations. Now you've got the problem with CDOs, collateralized debt obligations. These are increasingly becoming a huge problem as well in the financial system. Yeah, you've got commercial real estate, regular real estate, and just businesses, excuse me, becoming more and more precarious because of, I mean, Germany's a great example of this, but it's far from unique. All the alarm bells are going off all over Europe in terms of economies and the banking system there. So the question is, how long can you keep this going? And you made the point, Ken, before we came on about the reverse repo market. What was the figure down to now?
Yeah, it's down to less than 120 billion, where a few years ago it was up as high as 2.5 trillion.
Yeah, so where's that money gone? I mean, that's you
Yeah,
know,
and real quick, I was going to bring that up in the thing. What people don't realize is that overnight reverse repo was taking the treasuries held by the banks, many of the primary dealers, and lending them overnight, giving them overnight loans to be able to do for cash and this and that. Well, if we've gone down from 2.5 trillion to 120 billion, that means that these banks no longer hold treasuries. There's nothing to reverse repo. That's what people need to understand.
yes, absolutely. I was posing it as a question, for just discussion purposes, and you're absolutely right, and that again is an enormous problem because the question is, where do those treasuries go to, and why? And so, like everything else with financialization, when you scratch below the surface, there is a multitude of problems that aren't going away. They're just getting worse and worse. And really, when the Fed's lost control, the US Treasury's lost control, the US government's lost control of everything, where you have just, you can't have so-called austerity in the United States. It's impossible. So your debt is only going to rise and rise and rise. You're going to print to infinity. No one's going to buy US treasuries. No one's got any confidence in buying US treasuries at all. It doesn't matter whether it's foreigners or domestic. So this creates a huge problem that's just getting worse and worse. And the question is, how long is it before the proverbial dam breaks? And we're not here to put a time scale on this, but from my perspective, doesn't mean it'll happen tomorrow, but we're in that window where it's becoming completely untenable. And it always comes down to the fact when the US Treasury, US dollar complex is increasingly not seen as a safe haven, which it isn't, then the writing is totally and utterly on the wall.
Absolutely. Anything, I think we covered quite a bit today, Paul. Probably a good time to stop.
Yes.
Want to thank you as always for being a part of this great discussion and the insight that you share.
No, and likewise.
And to everybody here at the Sirius Report community, thank you for all the support you give. Don't forget to like, share, subscribe, comment, send this out to anybody you think might be important to. And until the next time we get together, have a great day.